Daniel, can you hear me?
Yes, good morning. I'm here.
Hey, where are you broadcasting from today, Daniel?
I'm right outside of West Palm Beach, Florida, a little town called Loxahatchee.
Sounds Floridian.
Definitely.
Uh, Let me give you a quickie intro here. Daniel Sugar is a third generation Chicago floor trader whose grandfather, Samuel, traded butter and egg futures in the early 1900s at the Chicago Butter and Egg Board, which eventually became the Chicago Mercantile Exchange. Dan understands that traders need to develop their own specific style and personal plan to be consistent with their personality, objectives, and temperament. His main goal as an instructor mentor is to help students gain trading skills and knowledge by sharing his vast experience and giving students and rules and tools to engage and participate in the market for many years. Uh, Daniel, the last time I was on the Merc floor, I found the cheese exchange, and they had a piece of paper taped to a wall, and it said the price of cheese is X, and that was it. That was
Talk
all
about
that was left of the Chicago Cheese Exchange.
price discovery and open outcry, right?
Yeah, right. And I just thought, oh boy, this place isn't going to last very long. And that was about 20 years ago. Okay, you have until 5 minutes before the hour, and then we give away our next batch of prizes. And I'll be sitting here with rapt attention. So I'm going to mute myself, and you have the floor.
Great. Thanks so much, John. I appreciate it. You guys can see my screen, correct? Just make sure the screen sharing is working.
Yeah, trend lines and patterns.
Perfect. Great. Thanks so much. Well, I'm really excited and fired up to be here. This is my second year. Did it last year and had a great time. So I'm really looking forward to my little 55 minutes here. And I got a lot of great information to share, folks. So I definitely would either take some screenshots or grab a paper, legal pad, and some notes, or your pen and pencil to grab some notes, because I know I got a lot of great information to share with everybody. So let's just dive right in. And like I said, I did it last year, and I actually sat in on about 4 or 5 other presentations last year over the 3 days, and just checking out what some of my colleagues and some friends were talking about and doing. And it's just a lot of great speakers. So I'm gonna do the same thing later today, and looking forward to a couple presentations tomorrow. And if I can pick up a few things to either add to my presentation or add to my own personal trading, it's well worth it. And I did that last year, and I'm looking forward to doing it again this year. So let's dive right in, folks. There's my website, trendlinebreak.com. My ethos and my mantra is integrity, transparency, and performance. Little disclaimer that there are inherent risk in trading stocks, futures, options, forex, of course, crypto. One of my favorite sayings is, if you don't manage risk, you're not going to have any risk to manage. So first and foremost, you guys are always going to be risk managers. Every email I send out to my database, every time I do a presentation, my salutation is greetings, risk managers, or good afternoon, risk managers, because that's if you don't manage risk, you're not going to have any success or longevity in as an active investor or trader. So definitely want to drill home that point. You got to manage risk, folks. Love your little losers. Love your little losers. Being a part of a group of like-minded individuals with the same learning aspirations, goals, and approach allows for greater learning. The whole is greater than the sum of its parts. We believe in progress, not perfection. And our mission statement is, we strive to be the premier online trading community and platform for successful swing traders of all asset classes. So we have a swing trading group, which I'll mention a little bit later, but that's our little mission statement. I did come up with an ebook. I published an ebook about 3 weeks, maybe a month ago, on trends, trend following, and trend lines. And this presentation is going to be discussing how to trade a bear market. NASDAQ's been in a bear market for about 3 weeks or a month. And officially, I think it was yesterday or Monday, was the S&P dropped 20% from its most recent high, which is the definition of bear market territory. 10% is a correction. 20% is a bear market. And I like that little saying, like, it's a recession if your neighbor loses his job. It's a depression if you lose your job. So that's kind of an interesting perspective. But, folks, if you look at the big picture, we've had a 13 or 14 year monster Fed-induced rally with creating a lot of liquidity, cheap money, low interest rates. We troughed back in March of 2009, and we peaked in, basically January of 22. So almost 13 years or so. Trees don't grow to the sky, right? Trees don't grow to the sky. There's going to be some pullbacks, retracements, bear markets, and we're in one right now. So, the big question is, are we going to go down, 40, 50, 60%, like we have in, 2000 to 2002? The NASDAQ dropped about 85% in the dot-com bubble, January of 2000 till about the summer of 2002. QQQs went from 120 to 20, so 85%. And then, NASDAQ, Dow and S&P got cut in half. People's 401ks turned into 201ks, if I can make a little joke about the retirement. But seriously, there are ways to time the market and use trend lines and trend following to A, help you lock in profits after a nice run, B, trade with the trend, and C, be ready for the eventual trend line break. So how to trade a bear market like the hedge funds and institutions. I did learn trend lines from a very successful hedge fund, single owner hedge fund manager, Richard Scalone, Integra Investment Management down here in Boca Raton from 2010 to 2013. I was in their proprietary trading room, and I got to learn from and study with a very successful hedge fund manager. He took $1 million hedge fund to $1 billion in 10 years, 1997 to 2007. Prior to 1997, he worked as a Forex institutional trader for JP Morgan. And then he always dreamed about starting a hedge fund. And he started it with $1 million, 600,000 of his own money and 400,000 of friends and family, because it's hard to attract institutional money when you don't have a track record yet. So you scrape up what you can scrape up, and then you perform. And in 10 years, it went from $1 million to $1 billion. And he taught me trend lines and a lot of other things. So there's my little picture of the floor with one of my students made this for me. My corporation is called LaSalle Wacker Trading and Teaching. A lot of people ask me how I came up with that name, but the Board of Trade is on LaSalle. If you can detect dialect, I'm from Chicago. I've been down in Florida about 20 years, but I haven't lost my Midwestern dialect. So the Board of Trade is on LaSalle at Jackson, and the Chicago Merc was on Wacker. So, and then I grew up in Lincolnwood, Chicago, the first suburb north of the city. So Lincolnwood, and trading is all about losses and wins. So I came up with this little LW, LaSalle Wacker Trading and Teaching. So my name is Daniel Sugar. Great to be with everybody. I'm your coach for 55 minutes here and your presenter. And it's good to be back with the Mad Hedge Fund Summit. So John already kind of gave you my little bio, but my grandfather and my father were both floor traders. So I'm a third generation Chicago floor trader. Anybody saw the movie Trading Places with Eddie Murphy and Dan Aykroyd shouting and screaming in the pits? That's what I did. And I left in March of 1996. I saw the writing on the wall about electronic trading starting and the death of the floor. And I was about 4 or 5 years early, but I got a good head start on learning how to trade from the screen. So my grandfather traded butter and eggs. John was talking about cheese, and actually milk was at the Merc as well. But before there were soybeans and bonds and S&Ps, there was butter and eggs. And my grandfather was it was called the Chicago Butter and Egg Board. And then it eventually evolved into the Chicago Mercantile Exchange. And then my dad was at the Board of Trade. He went to a couple years of college and then started the Board of Trade in January 1950 and was there for 35 years. So I did the 23andMe and the Ancestry.com test, and my DNA came back XYT chromosome. So there's a little shot of my dad and the original letter of 1950. I believe in trust but verify. So There's a little shot of my dad. And then here's a couple things in case you watched like 5 or 6 of the presentations yesterday and the first one today, and you need a little humor. Here's a gentleman that's in court facing some felony charges, and he looks back at his attorney, and the attorney says, you know, don't worry, I've watched a lot of Law and Order. I got this, right? Gives you some nice comfort. And then here's somebody getting some surgery, some heart surgery or bypass, and he looks into the surgeon's eyes and says, of course I can remove your blood clot. I've got Wikipedia. And then the last one, you're on the plane buckling up your seatbelt, and you hear the pilot say, I've just finished a YouTube video on 747s. We'll be taking off shortly, right? So my point is, you can't just read one book or sit in on 3 webinars or watch a couple of YouTube videos and learn how to trade successfully, folks. It's one of the hardest things to do. You know, it's the cold, hard fact of reality. It's very difficult, but with studying, preparation, learning, practicing in simulation mode, getting in front of your screen, attending these, you know, summits and web classes, etc., you can really master it and do well. But it's a process that takes time. So if at first you don't succeed, try doing what your instructor told you the first time. And just a reminder, Michael Jordan and Tiger Woods had, you know, they have coaches every day, and that's what helps them stay on top. I hope your charts don't look like this, folks. Oh, you're in Palm Beach Gardens, Murrah? Nice. Yeah, that's only 15 or 20 minutes from me. Yep. Sounds good, Murrah. Thanks for sharing. But I'm an old school technician, chartist. You know, I think simpler is better. You know, keep things simple, keep it simple, students. I like the KISS method, keep it simple, students. You know, but the more complicated your charts are, you're going to, you know, probably not make the best decisions, right? So I'll show you some of my charts later. They're just clean trend lines and patterns, The only indicator I use is a couple moving averages, and that helps me stay on the right side of the trend. And moving averages are also called dynamic trend lines. So my trend lines I draw are rigid, and then moving averages can be considered dynamic trend lines because they're evolving as time goes on. But just keep your charts simple, folks. You don't want to have too many things on there. This is a very important slide, folks. I definitely would write this down or take a screenshot. But if somebody asks me what's the blueprint for success, or what are the top 5 things you need to succeed in my 35 years or so in the industry, my first job was in 1980 with E F Hutton. I'm sure John and a lot of folks out there remember E F Hutton. And, you know, back in the day, Merrill Lynch was pretty big, but E F Hutton was also pretty big as a brokerage firm and institutional trader and so forth. But when E F Hutton talks, people listen, right? So I was a runner on the CBOE when I was 16 in the summer. But number 1, you need a proven strategy with an edge, statistical edge, and you have to have the discipline to follow it, right? What good is a strategy if you're not going to have the discipline and self-control to follow it and take the entries and wait for the entries? Wait for your signal. So number 1, a proven strategy with an edge and the discipline to follow it. Number 2, as I mentioned, risk management. Small losing trades are okay. It's just a cost of doing business. I think if people get over the stigma of losing money, I haven't met too many people that like to lose money, but when you sign up to be a trader, it's part of the game. And if you think of your trading business as a business, every business has revenues and expenses, right? So your profits are your revenues, your losses are your expenses, and then you can get over that little stigma about losing money, folks. It's not a big deal. You know, so many people get that outcome bias. You know, nobody bats 100% or 1,000% on trading. It just doesn't happen. So if you get an email or soliciting, you know, that the system's 95% correct, you know, delete it and run the other way, because it's just not a fact. So I apologize. I got a couple Bernedoodles that see another dog walking by. Relax, guys. Daddy's doing a presentation. Chill out. Yogi, shh. Hey, silencio, por favor. Shh. My dog. Hey, my dogs are bilingual. Come on, relax, Yogi. Shh. Sorry about that. Hazardous working conditions at the home office. So risk management is very, very important, folks. Number 3, proper position sizing, folks. You know, if you're trading with $100,000, you know, you don't have to trade, you know, 3,000 shares of Apple or 10 crude oil contracts or 15 E-minis, right? proper position sizing is very, very important. Don't trade too large. A lot of folks like to do, or a lot of things I've read. Hey, relax. I got the landscaper, sorry too, folks. So here, relax. So you don't want to trade too large. Trade small, grow tall. You can make good money trading in small contracts, options, futures, small share stock size, etc. But don't trade too large. You get burned. The market's got an uncanny way of knowing when you're not following the rules. Okay, so position sizing is very, very important. You want to do like up to between 0.5 and 2% of your account. So if you got a $25,000 account, 1% is $250. That should be your stop. Or if you want to go to 2%, then you can do $500 stop. But that's it. So that way, if you're risking 1% of your account or 1.5% of your account, every trade's the same, right? Every trade's the same from a risk standpoint. So position size correctly. Number 4, you have to understand a little bit about probabilities. Successful trading is a game of probabilities. So good traders don't try to predict the market. They react to the market, right? And the volatility. So understanding of probabilities is good. If you're a good blackjack player or 5-card or 7-card Texas Hold'em player, that's not a bad thing. And then you also have to understand a little bit about risk reward. You want to have 3-to-1 risk reward setups where you're risking $250 to make $750 minimum, or risking $500 to make $1,500 or more. So you have to understand risk reward. You're going to be wrong half the time, or 40% of the time, or 65% of the time. So you're not going to make money if you are batting 50% and you're risking $200 to make $200, right? You can't be wrong half the time and take 1-to-1 risk reward ratios. It's not going to happen, just the math. And we'll dig into that a little bit more deeper as well. So, and the last thing is a sound psychology and solid mindset. Your edge starts in your head. Once you have a methodology, once you know your platform really well, you know your strategy down pat, then it's all about what's between our ears, and not letting fear and greed dictate your decision making. If you can control fear and greed, that is 80 or 90% of the battle. Okay, you're trading against yourself. You're not trading against market makers. You're not trading against hedge funds. When it comes down to it, you're trading against yourself. Do you have the self-control to put those stops in? Do you have the discipline to take your profits when the market's telling you and your methodology is telling you to take profits? So there's my top 5 things for success. Here's another way of looking at it. Your edge is going to be your trading methodology and your strategy, along with risk management and the proper mindset and psychology, right? The bulk of your trading profits come not from what you know, but how you think. The bulk of your trading profits come not from what you know, but how you think. Handle that fear and greed. That's the other guy's problem. I came up with this little document a couple of years ago, my pyramid to profits. My landing pages aren't working, folks. I was going to put a link in to get a landing page, but my landing page company, they have 99.99% reliability, but they're having some kind of glitch with technology today. So if you want to email me, I have a PDF and PNG of this pyramid to profits. I'd be happy to email it to you. But the foundation building blocks is your process. You have to have a process, of course. You have to be prepared. You can't just log into your account at 9:15 Eastern and start trading. You got to be prepared, do your analysis, draw your trend lines or whatever methodology you're using, get in front of the screen and be prepared. And patience is important. Patience is very, very important in trading, waiting for your right setups. We talked about psychology already. We talked about probabilities already. We already talked about position sizing. I love and teach 5 basic patterns, bull and bear flags, ascending and descending triangles, and a wedge. And then all those lead to performance. And then performance, of course, leads to profit. So trading and investing is a very performance-based endeavor. And they all begin with P. So I call my pyramid to profits. Again, if you want to email me, I'll be happy to send you a nice little copy of that. So a few things about bear markets, folks. Every decade there's 1 or 2 bear markets on average. We had the dot-com bubble 20 years ago. And as I mentioned, QQQ lost 80 to 85%. 120 to the intraday low was 1976 intraday low. Then we had the housing, savings or housing mortgage crisis, 2007 to 2009, subprime mortgage debacle, indexes lost, half, 50% or so. The average decline is about 37% on a bear market. Some are more, some are less, but the average going back 110 years of data is about 37% drop. And the average duration is about, 10 to 14 months. So let's call it a year, right around a year. Some are less, like the bear market we had 2 years ago. And when COVID hit, early March, late February, early March, we had a drop of 20 or 25% in about 3 weeks or a month. And then we went right back up. So that was a really short one. But others last 2.5 or 3 years. So markets take the stairs up and the elevator down. Sometimes it's the express elevator. So some of you out there that have been trading for a while, you know how to sell short or bearish, put option strategies with options, etc. But good traders and investors know that you can make money in bull markets, you can make money in bear markets, and you can make money in sideways markets. So fear and greed, great traders remain calm and cool under pressure. Don't shy away from volatility. Good traders embrace volatility. What I tell students and people that come to my webinars and so forth is, when the markets get volatile, like a Fed day today at 2:00, we got the Fed release or unemployment or any other kind of moves, just trade a little smaller. Trade smaller. You have to adjust to the market. The market does not adjust to us. So we have to adjust to the market, trade smaller, and you might have to increase your stop a little bit because the reward's going to be more as well. So risk is always commensurate with reward. So you might have to increase your stop a little bit, but you're going to be able to make more money during volatile markets. So trade smaller and adjust to the market, adjust your position size accordingly. Okay. Here's some statistics about bear markets on the S&P. As you see, there's 1 or 2 per decade. Back in 1929, we had the crash, of course, and then that lasted pretty much until 32, 33. We had another one in 34, 35. So in the 30s, I think we have about 4 or 5 bear markets. In the 40s, we had 4 of them. In the 50s, just 1. In the 60s, 2.5. In the 70s, 2. 80s, 2. 90s, we only had 1. Only 1 bear market in the 90s, July of 90 to October of 90. And then 2000, we had almost 2.5 years bear market. March of 2000, the S&P peaked, and then it troughed in October of 02. October of 07 with the subprime we talked about, that was about 17 months. And then the 1 month bear market 2 years ago, that lasted 1 month, 32%. So some good information about bear markets, folks. Again, trees don't grow to the sky. So here's a couple. Me and my partner, Matty Fishkind, he's my swing trader in my swing trading group, and he's my partner in the swing trading. He handles the stocks and does a lot of futures, but he's one of my most successful students that stayed in touch with me. He struggled for a decade, making some, losing some, and then he took my class in October of 2015. And then retook it online in March of 16, and he's been rocking and rolling for like 5-6 years now. Really good trader. And he's my partner in the swing trading group. But anyway, we were calling the top in late December, early January in our Slack group. And there's some of the messages in our Slack group. December 31st, watch closely. Could be the start of a major sell-off. January 6th, if you can read that small print. But I did a webinar right after Thanksgiving and said, hey, the trend is up, but we're looking kind of frothy, and we're going to wait for a trend line break on the weekly or daily charts. Look for some kind of bearish candle formation, either a tweezer's top or a shooting star or a bearish engulfing candle, because this might get ugly fast. And sure enough, the market turned January 3rd, and it's been going down ever since. So here's his equity curve for this year. My partner, Matty Fish, he manages about 4 accounts, his mom's account, his dad's IRA, and 2 of his accounts. But this is one of his accounts, and doing really, really well with 120 trades. This is live money. So I wanted to point that out. But he's a great friend of mine, my partner in the swing trading group. And he had a burning desire to succeed. again, 10 years in a row, making some, losing some, making some, losing some, but he's been rock and rolling and super profitable since 2016 now. So I like to talk about the history of trends and trend lines and trend following, folks. It's good to know a little bit about the history of a strategy and back testing it and the efficacy, et cetera. So part of my ebook goes into this, but Charles Dow was pretty much credited with one of the beginning, grandfathers of trend following, and starting out with his Dow theory and the Dow letters he wrote to the Wall Street Journal between 1899 and 02. Dow theory, W.D. Gann, Elliott. Yogi, relax, darn it. Damn it. I apologize, folks. The landscapers came at the wrong time. So sorry about that, but we'll work through it. Anyway, you've heard of some of these legends in the trading and investing game. W.D. Gann, Ralph Nelson Elliott, Harold Gartley, continued on with the trend following strategy. Edwards and McGee wrote a great book in the 40s. Bob Edwards and John McGee, Technical Analysis of Stock Trends, where they devoted 3 chapters to trend following. Richard Sabacher, Richard Wyckoff, Richard Donchian, and Richard Dennis. 4 of them are Richards, but all had a lot to do with the development and expanding on trends, trend lines, and trend following. And then John Murphy, a lot of people consider John Murphy one of the recent fathers of technical analysis. He wrote a couple of great books in the 70s, technical analysis of the financial markets. And for those of you that have been around the game for a while, you've probably read some of these books or heard some of these names. But I'm not here to shame, MACD or Fibonacci or stochastics or relative strength, but indicators are indicators. They're lagging because they're going off, they're tracking price or volume. So they're lagging by 3 or 4 candles or half hour or 3 hours or 2 days, depending on whatever. But I think so many people get hung up on indicators and they miss, the leading indicators are price, volume, trends, and patterns, in my humble opinion. So a little history of trend lines and trend following. Richard Dennis was famous for the turtles, the Chicago Turtles, which we'll talk about in a minute here. Some of you may have read some of these Jack Schwager books on market wizards, interviews with top traders. He wrote about 4 or 5 of them. The original market wizards, new market wizards, and then his latest is unknown market wizards. And there might be 1 or 2 more, but great books about hedge fund superstars, floor traders, and some mutual fund money managers that really did well, and so those are great books. But a good amount of the market wizards were trend followers. Okay. That was their methodology. That was their strategy. So not everyone, but a good amount of them. And then Richard Dennis is a Chicago trading legend. He has started the Turtle Traders. He had an argument with his partner, William Eckert, about, Richard Dennis said great traders can be taught a system and methodology. His partner thought that great successful traders were born and you couldn't teach them. Well, Richard Dennis won the argument. You can teach, novices a methodology and strategy, and if they have the discipline to follow it, they can become successful as well. And Richard Dennis taught the Turtles a trend following strategy back in the 70s and 80s. And it was based on Donchian channels, but it was trend following. And there's an article in Wall Street Journal in 1989. But this is a good quote on the right here: to follow the good principles and not let fear, greed, and hope interfere with your trading is tough. You're swimming upstream against human nature. There's nothing quite as good or bad as trading. They give you a number every day. That's what's good about it, and that's what's bad about it. That's what makes it hard. That's what makes it worth doing. Again, if you can control fear and greed, it's not easy, but if you have a methodology, a plan, and a strategy, you can keep fear and greed under control. You're going to increase your probabilities of success exponentially. So the Turtle Traders. And my father actually filled orders for Richard Dennis in the bean pit in the 70s. Richard Dennis knew that my dad and his partner were the top soybean spread brokers in the pit, and they worked their orders to get good fills for the customers, good executions. And so Richard Dennis gave my dad a lot of large orders, spread orders in the 70s. So it was kind of neat that my dad filled orders for Richard Dennis because he didn't spend all day in one pit. He'd go to New York when oil or gold was moving. He'd be at the Chicago Merc when cattle or hogs were moving. He'd be at the Board of Trade when soybeans or corn was moving. So he'd go around to the hot markets. Other people like my dad spent all day, every day in the same pit, banging out the trades, banging out the brokerage, et cetera. So, but if you're not aware of him, folks, Google Richard Dennis, Chicago turtle traders, or just turtle traders, and you'll see a lot of great information. A lot of them wrote books. Michael Koval, Curtis Faith, Russell Sands, who were some of the original turtles. They wrote some books. But again, all the turtle traders used trend following. Okay. And then I like the little quote in the upper right hand, or a little note in Richard Dennis's office: losers average losers. What does that mean? If you buy Microsoft and it goes down $5 or $10, do you buy more? I mean, dollar cost averaging is a strategy for investing, but for trading, when you buy something and it goes down, don't buy more. Get stopped out, take your small loss and move on. Or when you sell short, don't sell something and then it goes against you and you sell more and you sell more and you try to average down. And that's not a strategy, folks. That's hoping and wishing and praying, and it does not work. So don't average your losers, okay? All right, so here's a little bit more about some important math to understand, folks. Again, it's all about probabilities, and I use my baseball analogy. If you can hit 300 in the major leagues, you'll make $10 million a year. And the same thing in trading, folks. Nobody bats 80 or 90%. So you can make 100 trades in a quarter and have 35 winners and 65 losers and make good money. You can make 1,000 trades in a year or 10,000 trades in a year and have a batting average of 30, 35, 40%. You'll have more losers than winners, but your losers are small, and some of those winners are big. Some of those are 2-to-1, 3-to-1, 4-to-1, but out of those 35% winners, maybe a handful, 5 or 10 of them or more, was 5 or 6 or 7-to-1, where you really caught a good trend and you stayed with it and you were patient, and it was a great 3-week trade or 6-week trade, and you made 8-to-1 or 6-to-1, where you risked $500, but you made $3,000. So to make that math work out, you got to cut your losses, let your winners run. Cut your losers, let your profits run. And one of my other favorite sayings, I'm a big collector of Wall Street quotes and Wall Street adages. It's not about being right or wrong. It's about how much you make when you're right and how much you lose when you're wrong. How big are your winners on average, and how big are your losers on average? You got to have that data, whether it's, TradeStation, Fidelity, Schwab, Interactive Brokers. Get one of those Excel spreadsheets, and you got to track your data. And, what kind of risk reward can you expect? What kind of reward can you expect on your methodology and your strategy after 100 trades or 1,000 trades? So it's not about being right or wrong. It's about how much you make when you're right and how much you lose when you're wrong. But if you can hit 50%, great. If you can hit, 40%, and 60% losses, that's okay. If you have a week or a quarter where you hit on 2/3 of your trades were winners, 65%, fantastic. But just understand the law of numbers and the law of averages. You're going to get, back down to that 50-50 or 45-55, percent or ratio, and that's okay. I wanted to point out also, folks, you can use trend lines and patterns for any trading style. For you day traders out there, short-term swing traders, where you hold something for 2 days to maybe 2 weeks, and then position trading, where you hold it for maybe a month to 3 or 4 months. And you can also use trend lines and patterns for investing. So it's, I call it fractal, this is a fractal methodology. And you can also apply it to any asset class. It's universal: stocks, exchange traded funds, options, futures, and Forex or crypto. Once you learn trend lines and patterns, a chart's a chart, right? Or if you're from Boston or New Hampshire, a chat's a chat. All right. Here's a couple quotes, folks, from, yeah, I used to say that, Stephen, by the way. That's a lot of Richards, right? I used to say that, but I want to try to keep it relatively. But yeah. Here's another quote from John Murphy, folks. Again, one of the fathers of technical analysis. He says, the trend line is perhaps the simplest and most valuable tool available to the chartist or available to the trader. Simple and valuable. And this is coming from, a godfather of technical analysis. And then the second thing I really love that he says, the violation of a trend line is often the best warning of a change in trend. also known as hashtag trendline break, right? That's my website, trendlinebreak.com. Do they always work? Of course not. But man, they work a lot, and I'll show you some examples. And the beauties and the simplicity. You know, some people say, well, Dan, trend lines are great, but they're very subjective. And my answer is, if you don't know how to draw them and you're not educated, they can be very subjective. But once you know how to draw them, they're very objective. It's either there or not there. They're very objective. So, but you got to learn how to draw them. So a couple applications, the three major applications for using trend lines are going to be, number one, to lock in profits on existing trades or investments by using a sell stop order below the trend line, not 3 ticks or a nickel below, but give it a little breathing room. But if you have a nice uptrend line on a daily or weekly chart and you're riding in trend for 6 months or 2.5 years, whatever, you can put a sell stop a little bit south of the uptrend line. And if the trend line, if price action or the candle goes down and breaks that trend line, it'll kick you out and you'll lock in some profits. You know, and I'll show you an example on Netflix or Nvidia or Shopify or Peloton. But Peloton went from what, $1.20 to $10 a share. But there was trend line breaks on the weekly and daily charts. I like the higher time frames. HTFs, higher time frames are where it's at. That's what the institutions use. So I'm not a big advocate of the 5-minute chart, but there are great examples of when the trend line broke. That was a great time to lock in profits on your existing trades or investments. Excuse me. The second way to use trend lines is to locate favorable locations on a chart to join an existing trend using your 3-touch confirmation strategy. So pretty much the universal thought is, when you have a third touch of the trend line, that's when you get confirmation we have a trend. Dallas or Houston, we have a trend, right? So 3 touches confirmation. You want to, if the trend is up, you want to buy pullbacks to good support zone or demand zones or uptrend lines. In a downtrend, you want to short the rallies at resistance or supply or a downtrend line. And that strategy has been working for over a century, you know? So that's very important. And then the third way, we want to help recognize when the current trend is ending and a new trend forms in the opposite or reverse direction. Again, trend line violation or trend line break. So again, it doesn't always work. If you're looking for something that always works, you're in the wrong industry, because nothing always works. But trend lines and patterns generate a lot of low risk, above average reward, above average probability opportunities. And that's what you're always looking for, folks. Write that down. You're looking for low risk, above average reward, above average probability in your process, whether you're using MACD, Fibonacci, stochastics, RSI, order flow, whatever you're using. Low risk, above average reward, above average probability. That's the name of the game. And then a couple more things about trends and trend lines. Because trending markets offer the best profit opportunities, one of the most basic goals of chart analysis is to define and identify the trend so we can analyze and join them. Look for spots to join the trend. And you've heard, you know, the trend is your friend, right? Until the bend at the end. One of my students in Austin years ago, talking about Texas, I had a student in Austin years ago that said, hey, Dan, if the trend is your friend, can the trend line be your best friend? I said, yeah. Can I use that? Your trend line is your BFF. Exactly. So, and then here's the strict definition of an uptrend: higher swing lows and higher swing highs. Some people call them pivots. Pivots and swings are used interchangeably. So higher pivot lows and higher pivot highs, or higher swing lows and higher swing highs. The buyers are in control. Okay. During an uptrend, higher highs and higher lows. Just keep it simple, folks. You know, after my students take my class, they can look at a chart and just see, you know, quickly, you know, after a little practice, but, you know, after, you know, several sessions and some practice, you can look at a chart and just see, oh, that's a trading range, or that's a downtrend, or that's an uptrend pretty quickly. And then you want to drill down deeper and find, if it's an uptrend, where can I get long? What kind of pullback or retracement to a support zone or demand zone or an uptrend line can I get long to join the trend? Trends are powerful. Trends tend to perpetuate, right? And then if it's a downtrend, the definition of a downtrend: lower swing highs, and lower swing lows. The sellers are in control. Controlling swing highs are in control. And again, lower pivot highs and lower pivot lows, if you want to call it pivots or swings, those are used interchangeably. One more thing that I'm just popped in my mind that I want to share as well is you want to gauge, like, if there's a trend, how strong is it? Is it just like, is the trend up and it's just kind of grinding higher, boring, grinding higher, like a stair step? Is it a nice little wave higher, or is it a tsunami, right? So if I can use my little ocean analogy, is there little ripples? Is there a wave, or is it a tsunami? And right now we're in a tsunami downtrend. I mean, since January it started, but lately it really exacerbated. And I'm going to show you this wedge pattern on the daily chart that we caught in the swing group last week. I mean, Thursday, Friday, Monday, Tuesday. It broke a trend line on the daily chart, and it came out of a wedge, which is just two intersecting trend lines. We had a nice rally in late May and early June. We went into a little trading range for about 7 days on a daily chart. And then Wednesday and Thursday, it broke out of it to the downside. And here we are 4, 5, 6% down in 2.5, 3 days. So there's your definitions, folks. Some more useful information. Trend lines are used to help traders and investors identify the status of current uptrends and downtrends. That's very visual. You can see the trend line on your chart. Once you know how to draw them, it's very visual. And all of technical analysis is very visual. Uptrend lines connect a series of controlling swing lows. Downtrend lines connect a series of controlling lower swing highs. And there's your 3-touch rule. Some additional rules to keep in mind. Again, trends tend to perpetuate. The probability of an established trend continuing is a lot higher than it reversing, right? Trends are powerful. The stock market had a 13-year uptrend. Were there some 10 and 15 and 20% pullbacks during that? Of course there were, but we always ended up making higher highs and higher lows after those pullbacks. So currencies, oil, gold, crypto, you can trend for 3, 5, 10 years. And you can notice that on a higher time frame chart, like the daily or weekly. We can add a little biology or chemistry in here. A trend in motion tends to stay in motion until acted upon by an outside force. Oh, did I say chemistry? I meant physics. Just making sure you're not sleeping yet. We got 15 more minutes, folks. Stay with me. Some good information here. It's also important to recognize and observe the slope or the angle of the trend line. Some can be 60 to 75% or degrees, if you will, and some can be parabolic, like 85 degrees. So you want to keep an eye on the slope or the angle. So here's a good little graphic about the ones on the left are continuation. There's some higher highs and higher lows. The third touch, you want to go long at the third touch on the uptrend line here. In the bottom left, you want to go short at that third touch. Your risk is on the other side of the trend line. So it's low risk. You know where you're wrong. And then the reversal trend line break is on the right-hand side. Just a basic visual graphic, folks. Keep it simple. Simpler is better, in my humble opinion. Let's spend a few minutes, folks, on the stock and bond correlation. We got the Fed meeting at 2 o'clock today, but some important things to realize. Good stock traders and futures traders on stock indexes or options on stocks like SPX or Russell or Dow, whatever, NASDAQ. Good stock traders understand the relationship between the bond market. Okay. I was in a 30-year bond pit back in the day before I left the floor, 30-year bonds, ZB or US. But, a couple of quick bullet points. The FOMC has been dovish. When they're dovish, they're easing and creating liquidity, keeping rates low on mortgages and car loans, et cetera. They used to purchase 140 billion in securities every month, creating cheap money and liquidity, but that game is over. Quantitative easing, you've heard. Stocks love low interest rates. After 8 or 9 years, they've turned hawkish. They've been telegraphing their hand since January and February, those first meetings of the year. Some of you folks have been around the game like I have for a couple decades. Remember a gentleman named Marty Zweig. He was famously quoted as saying, "Don't fight the Fed. Don't fight the Fed." And folks, that works both ways in dovish markets with easing and liquidity, and in hawkish markets when they're raising rates. It works both ways. So the Fed has a huge influence on the stock market, more than presidents, more than a lot of other powerful inputs. So the Fed is the name of the game. So, and if you understand the Fed and the relationship, you can keep it on the bond market, but don't fight the Fed. markets don't go in straight lines, but there's going to be some opportunities, and you want to trade with the Fed, not against it. Don't fight it. So equities don't like rapidly rising rates. And the normal correlation, folks, the normal stock bond correlation is stocks up, bonds down. Why buy bonds that are paying you 1 or 2%? Well, now they're 3 or 3.5, whatever. But back in the day, for many 40-year bull market of bonds, they were hardly paying you anything. So why lock up your money for a 10-year note or 30-year bond at a ridiculously low interest rate that barely covers inflation? Back when inflation was 1.5 or 2%, not 8.5. But that's the normal correlation: strong stocks, weak bonds, or weak stocks, strong bonds. When stocks drop, you get a flight to quality, and people dump their stocks and they buy bonds, and it was called the flight to quality or flight to safety. But the anomaly is when bonds start dropping fast, when T-bond futures drop fast, there's an inverse relationship between yield and price, as I'm sure most of you are aware. So when futures go down, that means yields or interest rates are going up. So when bonds go down fast and furious and rates spike, the stock market goes the same way, down. So there's the anomaly. The normal correlation is strong stocks, weak bonds. But when bond traders push that bond market down and the rates spike, like we've been having since January, then stocks and bonds go down together. And that's what's been going on. So you want to understand what scenario are we in? Are we in the normal correlation, or are we in the anomaly? And lately we've been in the anomaly. So here's another great example of why risk management is super important, folks. If you lose 10%, all you have to do is make 11% back to get back to break even. If you lose 50% of your account, you're going to have to double your account just to get back to break even. So again, risk managers, be a good student of managing your risk. Very, very important. One of the most common causes of failure is the habit of surrendering to temporary defeat. A quitter never wins and a winner never quits. So some of you folks have been through a couple accounts, or I've known some great traders that blew through 2 or 3 accounts, but they had a burning desire. They knew there was a way to make money, and they studied and learned and paid for some education down the way and had some great mentors, and then they got it, and now they never look back. So don't quit. If you have a burning desire and you're really, really hungry, have at it, keep with it. Quit burning money. And if you're losing money with your methodology and strategy, stop. That's the definition of insanity, right? And then when the student is ready, the teacher will appear. I love that little quote from Buddha. Here's a couple testimonials and some social proof from some of our students in the swing trading group, etc. So I'm kind of running out of time here, but I got a few more things I want to cover. Some more social proof, etc. I believe in trust but verify. Here's a gentleman dreaming about a trend line with his girlfriend or his wife, who's dreaming about Valentine's Day or their anniversary. So I got that from a student years ago. So let's take a quick look at the charts, folks. I want to show you, this is the S&P weekly chart, folks. S&P weekly. There's the peak in January 3rd. There's your first trend line break, January 10th. This is a weekly, so each candle is 1 week of data. There's your first initial drop, 10, 12%, whatever it was. We had a nice rally, a little double top up here. And then there's a trend line break right there, April 4th. And then if we're down here, folks, we had that big rally 3 weeks ago, right? And then if we're down here where I have my ellipse, if you look up and to the left, you grab that swing high or pivot high and you connect the highs, connect the dots. So there's 1 touch, 2 touch. There's your 3rd touch, the week of April 18th. We have a downtrend, 3rd touch. We opened down here, ran up, hit that 3rd touch, and then by the close of the week on Friday, they closed on their high knee, week close. 3 touches. And then we had a nice dead cat bounce rally for a strong week. The next week, we opened up on Sunday night futures, rallied up a little bit. Look at that 4th touch, folks. There's your 4th touch 3 weeks ago, Sunday night and Monday. The market stopped, the buying stopped in its tracks at the 4th touch trend line. Do you think that's random or arbitrary? I don't think so, but I'm biased because I love trend lines. But that's your 4th touch. You want to go short and join that downtrend at or as close to that trend line as possible with your buy stop above it. You can buy puts on SPX. You can buy spider puts if you're an options trader. You can sell short mini S&P futures or micros. You can sell short SPY. You know, this is the index, so there's all kinds of derivatives off the index you can use, options, futures, whatever, or ETFs. And then look at the fifth touch the next week, last week. There's the fifth touch. We open up Sunday night, ran up Sunday, Monday morning, maybe even Tuesday, hit the trend line for the fifth touch, and then dropped. And folks, this is the weekly chart. So, you know, even if you're a short-term day trader, there's a lot of value in looking at the forest from the trees, right? Look at that higher time frame twice a day, once in the morning, and then one more time at 12 noon or 1 o'clock, just to reorient your brain on the big picture. Even if you're a 5-minute day trader or really short-term oriented, keep in tune with the bigger, higher time frames. That's what the institutions do in the hedge funds. So there's 5 touches, and then we dropped hard. Very, very important. And then I want to show you the daily wedge that I talked about that we caught. This is the daily chart of the mini S&P. There's the big drop. We broke a bunch of trend lines. We rallied for 3 days in a row. And then here's that 7-day chop and slop. We're getting tighter and tighter. And a wedge or symmetrical triangle is just 2 intersecting trend lines. The market gets tighter and tighter, chops people around, and then boom, you get that inertia breakdown. Here's a little breakdown that didn't work. This dropped for like 40 or 50 points, but then it ran right back up. We had a double bottom there. There's your triple bottom. It ran back up. But then right here, folks, it was the last Wednesday or Thursday, the 8th, actually Wednesday, a week ago today, we closed below a little trend line here coming out of a wedge. Wednesday at 5 o'clock Eastern. There's Wednesday night and Thursday night and Friday, and then Sunday night. But coming out of a wedge, folks, rally, base, drop, or impulsive move, corrective action, chop and slop, getting tighter and tighter, and then bam. And there's no demand. There's a huge trade there. We caught that in the swing trading group. So anyway, a couple chart patterns, a couple trend lines. One more testimonial of a gentleman who took my class in May, 6 weeks ago or so. I don't want to spend too much time out because I only got a few more seconds or minutes here, but we went at a good pace. But trend lines and patterns, folks, keep it simple. I do have a lot of different offerings. I have my ebook. I wanted to put some links in the chat here, but I do have the ebook one I can put in here. But my other one with the pyramid to profits wasn't working, so let me put that in there. Here's my ebook and see if that works. Yeah, there you go. And then so I have stuff anywhere from $3,500, a complete 2-month mentoring package, which consists of my 4-day class plus a 90-minute private consultation on Zoom. You keep the recordings of the class, you keep the recordings on Zoom of the private consultation, 2 free months in my swing trading group, plus I'll throw in the ebook. That's normally $4,500. I'll do it for $3,500. Complete 2-month mentoring coaching program. If you want to buy the recording only, the class recordings from the May class only, I'll give you 2 free months in the swing trading group and the ebook. That will be $2,250. If you want just consultation, depending on your budget, you want to spend 2 90-minute sessions, 3 hours with me, private. You keep the recordings as well. I'll go over trend lines and the curriculum and make sure all your questions are answered and make sure you get it. You get 1 free month in the swing trading group plus the ebook. And then I have a little mini class, Introduction to Trend Lines, I just created for $375, 2 90-minute sessions. That's going to be a week from tomorrow, Thursday, the 23rd, and then Monday. The first day, 90 minutes will be curriculum, theory, PowerPoints. And the second one is all charts, folks, live trading, live charts, question and answer. I'll draw a ton of trend lines. I'll go over patterns. And that will be $375. Okay, so again, my email address is dan@trendlinebreak.com. I'll type that in the chat. You already have my website. If you have any questions about anything, let me know. trendlinebreak.com. Any question, anything, just email me. And I think that's it. Wow, 10:56. So pretty close to the cutoff time. If you want to check out the ebook or have any questions about the packages, email me or let me know. Oh, let me put the link in for that little I have the other package. That my last link.
We already have it in there, Daniel.
Oh,
just look in the chat box on the right. and you will see a link to the dedicated sales page with
Great.
Daniel's unique offer.
Thank you very much, John. I appreciate it. Thanks, everybody. Appreciate your time.
Hey, great having you today. Great presentation, and we look forward to having you back.
Thanks again. Looking forward to it again.